Welcome, everyone. Hi, everyone. I'm Corinne Michelle, and I'd like to thank you for attending this webcast. Before we begin, I'd like to go over a few housekeeping items. First, we encourage you to ask questions. To do so, please use the chat functions, and we'll try to answer your questions during the webcast, if possible. But if you need a more detailed answer, please reach out to us via email. We will also be displaying some polling questions throughout the webcast, and we encourage you to submit your answers. After the webcast, all attendees will receive a copy of Mazars M&A Playbook. It's called Adding Value for Buyers and Sellers, a detailed guide on the M&A process. Attendees will also have an exclusive access to a free 30-minute M&A consultations with our speakers. And today we will be presenting Preparing for the Eventual Sale of Your Business. And joining me are Michael Rothman, partner at Mazars, Ray Feldton, co-managing partner at Greenbaum, Rose, Smith & Davis, and Brian Maloney, who's the CEO at Silver Grove Advisors. Welcome, everyone. Mike.
Thank you so much, Corinne. And we have an all-star team here with Brian and Ray. The three of us worked on a lot of deals in the past several years and have a lot of experience and stories to tell. So I'm very excited about the M&A playbook and being able to custom tailor a strategic plan focused on adding value to sellers and buyers. This is something really going to add a lot of value. So my name is Michael Rothman. I'm an accounting and advisory partner at Mazars. Mazars is an independent member firm of Mazars Group, an international audit, tax, and advisory organization with operations in more than 90 countries. Our roots go back to 1921 in the US, and we have a significant presence here in the tri-state area, amongst other strategic geographies in the US. And we work with a wide range of companies, including startups, high growth and well-established family-owned businesses across all sectors. My expertise is within transportation and logistics and manufacturing and distribution. No matter the size of or type of the business, our objective is always the same: to provide the advice and services needed to help you and your company run effectively and efficiently. And we work with clients in a structured way to develop a strategy which meets the unique challenges of their business, the sector you operate in, all the time, ensuring it remains aligned to your values and your business ambition.
Great. Thank you, Mike. Brian?
Thank you, Mike. My name is Brian Maloney. I'm the founder and CEO of Silver Grove Advisors. Silver Grove is a merger and acquisition advisory firm based in New York City, and we focus exclusively on representing family and founder-owned companies in the middle market and lower middle market in sell-side engagements and other M&A and capital raising transactions. And as Mike mentioned, we've collaborated with Mike and the team at Mazars, as well as Ray and the team at Greenbaum on many deals over the last several years, and we look forward to sharing our collective experience with you today.
Great. Thank you, Brian. Ray.
Thanks, Corinne, and good afternoon, everyone. I'm Ray Feldton. I'm the chair of the corporate department, as well as the co-managing partner at Greenbaum, Rose, Smith & Davis, which is about a 100-lawyer firm, full-service business law firm. We have offices here in New Jersey, in Essex, Middlesex, and Monmouth counties. As both Mike and Brian said, we've collaborated on a number of transactions together over the years. We do not focus on a specific industry, but we do focus on the mid-market type of company. More on the sell side than the buy side, but we do buy transactions as well for a number of our clients.
Got it. Thank you, Ray. So how have you worked as a team? Like, how do you guys know each other?
Yeah, well, I can answer that question. We know each other quite well, having worked on many successful sell-side mandates over several years. I'll just share a few recent transactions as examples where we've collaborated with the teams at Mazars and or Greenbaum Rowe. One is a recent sale of a majority interest in a provider of botanicals, ingredients, and proprietary blends for the nutraceutical and functional food and beverage industries, a company we represented in a majority sale to a financial investor. Another is a third generation family-owned recycler and processor of recovered paper commodities, which we represented in a majority sale to a leading New York private equity firm. We represented a managing general agent of customs bonds and marine insurance in a sale to a large public company based in Canada. Mike and I worked together, and actually Ray as well, on the strategic sale of a contract manufacturer of printed flexible packaging for the pharmaceutical industry to a large public company in Canada. We've represented a leading regional distributor of collision replacement parts in a sale to a major buyout firm based in New York, in a transaction that subsequently resulted in a second sale of that company to a larger PE firm and a very compelling second liquidity event for that client. And similarly represented a leading inspection and testing company focused on oil and gas, petrochemical, and agricultural commodities in a sale to a large PE firm based in Pittsburgh. A few years later, in a sale that same company to a larger PE firm based in Connecticut. And that company and our clients in the original deal are now positioning themselves for what would be a third liquidity event.
Got it.
There's multiple other deals in marketing services, pharma, and transportation logistics on which we've all collaborated.
Got it. So you guys actually really know each other really well then.
Well, and I think key is that we do share a similar philosophy to getting obviously the best results for our clients, but also getting the deal done and not getting in the way of a lot of posturing or things like that. We bring similar philosophies to transactions.
Got it.
And just to add, Corinne, that obviously I mentioned there examples in multiple industries. The common denominator in all of these transactions is the founder, family ownership, and middle market, lower middle market company. And the value proposition that our three firms brought to all these engagements is the knowledge of all the unique dynamics of a family-owned company or founder-owned company, the generational family issues, the customer supplier, key employee issues, and others, and our high level of execution focus and senior level attention that we bring to make sure these very difficult deals get done. So the track record there has been highly successful. I actually can't think of a deal we've all collaborated on that didn't result in a successful transaction. And that's quite a differentiator in the middle market, lower middle market, which is just littered with busted deal processes and failed attempts at a sale.
Got it. That's so. Tell me, what is the sale process? So where do you start?
Well, that's once the owner of a family or founder-owned company pulls the trigger on this once in a lifetime or oftentimes once in a multi-generation process. It's generally a 7 to 12 month process, very intensive, and a real eye-opener for most of our clients. I think, to give that process justice here would be difficult, but we can try to give an overview of the major elements of that process in 7 to 10 minutes. If you bear with us, but really the foundational work at the beginning takes about 8 to 10 weeks, and that's includes our preparation of a very detailed memorandum, which positions the company to maximize interest from prospective acquirers and investors, and also maximize valuation. And that detailed memorandum generally includes like a very detailed market overview that positions the company relative to the salient trends in its industry, a very detailed company overview of its customers, suppliers, products, and services, its team, its facilities, and its history, and then a very detailed financial overview, which includes generally 5 years of detailed financial statements and 5 years of projections. So that's the memorandum. The other key elements are a very detailed grounds up financial model.
Yeah.
A sell side Q of E, which is something that Mazars generally takes the lead on, and the preparation of a target list for prospective investors and acquirers, both financial and strategic, domestic and international, and public and private companies. That foundational work is very important to position the company for success, and we generally aim to accomplish all that in an 8 to 10 week process, working with Mazars and Greenbaum from the time that we're engaged. So I'll stop there and then transition to the next steps in the process, unless there are comments that Mike or Ray want to add.
I'd just like to jump in on the, you mentioned the quality of earnings report. That's a form of financial diligence, or referred to as a Q of E, to make sure that the books and records are accurate. It's different than an audit where materiality is used. So consider if you have an immaterial adjustment in an audit, if you multiply that adjustment by a sales multiple, 6 or 7 multiple, you can imagine that it magnifies into a much larger issue. So you don't want that to impact your purchase price. And preparing a preemptive Q of E report, before starting a sales process makes a lot of sense to do it up front, because you get all the issues and skeletons out of the closet. It starts with fact checking. The books and records are well kept, accruals are properly made, earnings are normalized. The focus is to ensure that the company earnings and cash flows are sustainable. So, it helps Brian as the investment banker tell the financial story, and it shows to the buyers that you did your homework. You dressed up your financials to put it in the best light and eliminate surprises. There's nothing worse than in the last minute having surprises. And, we could spend an entire webcast talking about Q of E and its benefits. So I'm going to just save that topic for a future Mazars webcast.
I would add at this stage, we're all sensitive to the fact of confidentiality, which is crucial to essentially all of our clients. There's a lot of work that goes into preparing the information memorandum that Brian mentioned, into the quality of earnings that Mike was speaking of. And, we appreciate and have to deal with the dichotomy of getting all the information necessary to do that without bringing, maybe anyone other than the owners into the discussion. So we're sensitive to managing that, and we realize that sellers of a business do not want that to get out from under the tent to the greatest extent possible, total extent actually, and we're very careful about that and very sensitive to that. So we recognize that as an issue.
Yeah.
Yeah.
So that's really considered to be sort of like phase 1, the first 8 to 10 weeks. Yeah.
Right, exactly. This is the foundational work, which oftentimes is not done very well for lower middle market or middle market companies, and where we really feel that working with Mazars and Greenbaum, we're highly differentiated. And it's so important to position the company for success, a successful closing in a process like this. And too many companies and their advisors race to the next phase without having done a proper job in the first phase, and only to stumble later on. So at this point in the process, we're 8 to 10 weeks in. And we're now prepared with the memorandum, the underlying financial model, the target list. Only at this point do we then approach approved targets on that target list with what is just a 1-page investment overview, or commonly known as a teaser, as the basis for us to have discussions with those parties about their potential interest. Generally sending out those teasers, following up with phone calls, scheduling a call to discuss and really vet the potential strategic or financial investor on their really three parameters. One is their strategic rationale and motivation for the deal and their fit. You know, does that all make sense, or is it really not likely to make sense for either the buyer or the seller? What's their financial capacity and their balance sheet to do this deal?
Right.
Are they well capitalized?
Right.
And thirdly, what's their history and track record of accomplishing successful M&A deals? Because, you know, doing a deal with a party that's never done a deal before is, you know, really sometimes very challenging. So we like to see that history and success of getting deals done. And also, you know, we like to avoid parties that have a reputation or a history of getting companies under LOI and not closing or retrading deal terms. And so that's really the vetting that takes place with the teaser, and that's followed only when we're satisfied on those criteria do we enter into a non-disclosure agreement and share the confidential memorandum with the target as the basis for their evaluation of the opportunity. And it's that information memorandum that we prepared up front, which is going to be the entire basis for the next step in the process, which is asking for indications of interest,
Got
which
it.
are high-level offers that include evaluation or evaluation range and other high-level summary deal terms as a basis for us to further vet potential buyers, weed out any bottom fishers, and narrow the process down to somewhere between 3 and up to 10 parties that we would then invite to management presentation. So I'm going to again kind of stop there to see if Mike or Ray want to add anything on this next phase of the process.
No, just proceed.
So
Okay.
I do have a question. What happens if one of the buyer is a competitor?
That's a great question. That's a great question. A terrific question, because it's oftentimes the case that
Right.
some of the logical buyers or the buyers for which the company might be the best fit and the buyers which should be able to pay the highest valuation are competitors or other players in the industry. So this always comes up in
Right.
in a lot of processes. And there you have to be very careful about including those parties in a process. And when you do include them, really staging the information that's shared. So for example, we would always redact the memorandum, you know, names of customers and suppliers and employees, as well as other information that's highly sensitive. And so they would receive a different version of the memorandum than maybe a private equity investor that didn't represent any competitive issues for the seller. And then we continue that throughout the process, and it has to be done in a very staged way. And you have to be very confident and secure in that buyer's motivation for participating in the process.
Got it. So there's a tremendous amount of work involved. So it's like phase 1, 2, and 3. Now, before you start the sale process, what are the things that you can do as a seller to minimize your risk?
Yeah, well, I think there is a phase 3 here. Let's just cover that real quickly before we, so we're at the indications of interest. And based on those, we deselect down to anywhere from 3 to 10 parties we invite to management meetings. The management meetings are very important. This is the first opportunity that the prospective investors or acquirers have had to interface directly with our clients, the founders and families that own these companies and their teams, and hear the story directly from them. So those meetings take place, after which we provide the investors and acquirers access to a very detailed electronic data site as a basis for their continued due diligence of the opportunity. This data site is populated usually with hundreds, if not thousands, of documents, fewer earlier on and then more as the process continues, that provide the basis for us to ask for revised offers or letters of intent, which are now based on much more complete information, right? They've not only received and reviewed the detailed memorandum, they've now had a management meeting, which is oftentimes accompanied by a facility tour, if that's relevant. They've had access to a data site with a next level of detail, including that financial model that we prepared at the outset of the process. And now we're asking them to dot all their I's, cross all their T's, and give us a fully informed offer, which we will work with Ray and his team to negotiate on all the key points of value and risk that matter to our clients. And that we do all this before we give any one party exclusivity in a process, because we want to continue to leverage that competitive dynamic as long as possible. So I'll stop there because I see Ray may have a comment, and then there's a really final phase of the process that we can quickly cover.
Well, I would just expand on the point, Brian, about exclusivity, that once a letter of intent, which is not a legally binding document, but nevertheless does create some legal consequences, it very often will have various provisions that are binding, in particular an exclusivity period that can be typically 45 to 90 days. Exclusivity meaning that the prospective seller cannot negotiate or entertain offers or even engage in any sort of sale process with anyone else to give the buyer, who's going to be incurring all sorts of expenses and time involved in the process, which Brian will describe next, what comes next, a free or exclusivity, literally, that they're the only buyer involved in the process. And so once you've crossed that threshold, so to speak, by signing a letter of intent, there are consequences to it that you need to be aware of. And one of the debates, it's a little beyond the scope of this conversation, is how detailed or not to make a letter of intent. I've seen some that are tantamount to full-blown purchase agreements, others that barely have anything more than a purchase price, and that depends on the deal, depends on the parties, depends on a lot of factors, but it's certainly not a one-size-fits-all type of document.
This is another common mistake which results in a lot of busted deals or certainly not optimal deals is, we talked about doing that foundational work up front, and that's oftentimes not done properly. But then the other mistake is that parties enter too quickly into a letter of intent, which, as Ray indicated, gives one buyer exclusivity in a process. And at this point in the process, the leverage really shifts from a seller to a buyer, right? And a lot of buyers will use then the remaining due diligence period as a negotiation, a way to whittle away at the valuation, oftentimes significantly. And none of these deals that I mentioned at the outset have we had retraded on us following the signing of an LOI, and that's because we're very careful that due diligence is substantially complete, and that we've pinned the buyer down on all the key points of value and risk which matter to our clients, and that we have a high degree of certainty on getting to closing before we give one party exclusivity in a process. We don't want to give up that competitive dynamic or give one party that leverage until we see the finish line. And that's very important. From the time that you sign an LOI, and I'm talking about you're now generally 60 to 90 days away from closing. And this is the point at which the buyer or the investor will now spend real dollars engaging their own accounting firm to validate the numbers, which is why it's so important that we have done the sell side QEV with Mazars up front, because that really should result in no surprises if we've done the sell side QEV. They engage their buy side QEV firm, they engage their law firm, to begin legal due diligence. They engage an environmental firm to do environmental diligence, HR, IT, and so forth. And you got multiple streams of diligence. And sometimes, you know, there's over 100 parties from those various representatives on the data site evaluating the information. So you really want to make sure that you've provided that information earlier in the process and that there are no surprises which come up in due diligence, which would allow the buyer to either walk away from the deal or to retrade the deal. This should only be confirmatory due diligence in a properly run process. And the end of that process is, you know, working with Ray and his team to prepare the definitive documents, you know, which he can elaborate on, but really the primary ones being either a stock or an asset purchase agreement, depending on the transaction structure, the employment agreements, which are very, very important, especially in transactions where our clients are remaining with the company and oftentimes keeping a minority stake in the company. And then lastly, the operating agreement, which will, you know, generally govern our clients' rights as now minority investors in their company versus the new majority investors. Of course, there's many ancillary documents, but we won't cover those here.
So then it goes back to the questions. There's so many things you can do actually to minimize risk, right? So what are the couple of things that you guys can think of before you actually get to quote unquote phase 3? I mean, Mike, is there anything they can do on the tech side? And I'm sure Ray has a lot of things they wanted to say. Anything that you would like to add, Mike, on the minimizing risk?
Absolutely, there's so much, and in a well-planned, you know, in a well-planned deal or strategy to sell the company, you're going to find exactly what Brian says. It's going to be more confirmatory from the buyers,
Right?
Professionals. But you know, it starts with ensuring that the financial reporting is in accordance with GAAP, you know, and it's done in the most favorable way to present it. Many times we see owners not focus on interim financials and more focus on the annual, where the interim financials, monthly, quarterlies, they come into play. And if they're not in accordance with GAAP, you know, those things deteriorate buyer confidence. So those things are very important to maintain throughout the process, because it will have a final sales price impact. You know, and some companies that don't apply all the proper closing procedures and have the right policies and procedures in place and don't maintain that discipline, you know, they might end up with a lower purchase price, you know, and there have times where sellers, you know, and that sellers are looking at a lot of emotionally tied businesses, you know, family, multi-generational, and many times those sellers and those owner managed businesses have owner costs, you know, and that's they see it as the value of owning the business. They need to consider those as potentially add backs to the earnings, you know, and streamlining and normalizing the earnings. EBITDA is one of the more common benchmarks that's focused on, because that's a good sign of the company's earnings. But when there's add backs to the EBITDA, you know, those need to be considered and carefully maintained throughout, you know, the course of time, because any owner or family compensation and benefits that'll be non-recurring, any one-off items or other non-recurring items, you want to present those in a way that won't burden the buyer, but will know that it increases the value because there's more EBITDA there potentially, or an adjusted EBITDA after they take over the business. And the buyers, you know, they hire very well-known, prominent professionals, and they know exactly where to look, you know, and very often, you know, things come up related to tax. Many times it's around state income taxes. It could be franchise income taxes. So anything dealing with state and local taxes, we refer to it as SALT, are very common issues. We have SALT experts at Mazars that perform nexus studies focused on income taxes, franchise taxes, property taxes, withholding taxes, and not just pointing out the issues, but putting together a voluntary disclosure agreement and a plan to go back and fix the areas to avoid substantial reductions in purchase price, reduce penalties and interest. You know, buyers, like I said, know where to look, and this stuff comes up. You know, Ray can specifically speak to this, where there was a massive impact to a purchase price of several $1,000,000 because the buyers are unwilling to accept any of the seller's tax risks. Right. So in practice, I see many family or owner managed businesses think that they manage these risks, but the buyers, since they're unwilling to accept any of it, you need to get ahead of it. And
Yeah.
it will deteriorate buyer confidence and reduce the seller tax proceeds.
Yeah.
We let me just pick up on that in this stage of the process when both Brian and Mike mentioned confirmatory due diligence. What they're really saying, and from my perspective, and we as the lawyers don't get as involved in financial statements, taxes, and accounting. Obviously, we leave that to Mazars and to Silver Grove. But there's so many other aspects of a business, and that whole preparation stage involves doing your own due diligence, with the help of your professional advisors on your own company. And in addition to, tax accounting and financial elements, there's all sorts of issues about whether assets are where they should be, whether your corporate structure is proper,
Yep.
whether your employees are classified properly, whether your IT systems, data security, all that is going to be looked at closely. Intellectual property, is it owned by the company? Is it infringing on anything? If you go through the process at the early stages, again, with the advisors, to do all this due diligence, to be as prepared as possible, preferably to be over-prepared. You want to be prepared for every question you get asked and for questions you never get asked in a perfect world.
Right.
And you're going to be asked them multiple times, and it does get frustrating, even from the same buyer. And anybody who's had the misfortune of sitting through a deposition knows that the same questions get asked multiple ways as a way to make sure of the truthfulness and completeness and accuracy of the answers. Well, it's to a certain extent, it's not quite as torturous as a deposition, but it's similar, the approach that's taken in a buyer's due diligence, again, not just financial, but in all aspects of the business, and being as prepared as possible, being as upfront as possible. If you've got an issue, you don't want to wait for for example, a pending lawsuit, a pending environmental claim, something like that. Get it up front. You're not serving your own purpose, and you're not serving the purpose of the deal in terms of getting the deal done by not being upfront with that. Buyers, just like anyone else in the real world, in the non-transactional world, do not like surprises. And by being prepared for that and being upfront about it, because once a buyer, this is, poor analogy to a deposition, but once you're caught once with, you misstated, very probably unintentionally. I'm not talking about an intent to deceive or to conceal, but rather, I didn't think of that. Because, just like with our own flaws in our own houses, we just don't notice them after a while. It's the same sort of thing with your company. You sort of learn to live with the problem. Well, as Brian said earlier, the buyer's not going to live with that problem. He's going to leave it with you and as the seller. And being prepared as possible, for that diligence, that confirmatory diligence that you've been asked internally by your own advisors, every question possible.
Right.
That's what you want to try and do in all stages, so that when you get to facing a buyer who's prepared to pay substantial money to acquire your company, that you've got your story straight.
I'll just add, I know the Mazars team has taken the lead on preparing this seller's playbook, which is very important, outlining a lot of what we've talked about here today. But I want to make the key point that there's a buyer's playbook, which I think Mike alluded to. It's not maybe written, but all of these very sophisticated financial and strategic buyers have this process down to a fine art. And it comes down to all the levers they have to maximize value for themselves and minimize risk for themselves. Now, our goal as the representatives of family and founder-owned companies is to maximize value for our clients and minimize risk for them in a deal. And I think the big part of the value that, Mazars, Greenbaum, and Silvergrove bring to the table is that we know that buyer playbook inside and out. And we want to work with our clients to take away as many of these cards as possible as soon in a process to maximize value, minimize risk for our clients. And I think it would be helpful to really, we shared some recent deals as examples, but if we look at those deals, real deals, at the laundry list of issues that have come up, I think it would be really helpful to cover some of those, because a lot of those issues and risks that buyers identify, and they might ask for a reduction in valuation, they might ask for an escrow or a holdback of the purchase price, which we always want to avoid, or they might ask for a carve out to the reps and warranties insurance, or in the worst case, they might walk away from a deal over it.
Right.
And a lot of these issues, can be addressed months or even years in advance of a process. So, Mike mentioned sales and use tax or SALT taxes. Certainly that's come up. One that has come up on more than one deal that we've worked on together is S Corp status. So Ray, maybe you can speak to that one, which delayed one deal, resulted in a holdback on another. Fortunately, the holdback was ultimately paid, but having your proper S Corp status documentation is very important. If that applies to you, Ray, maybe you can elaborate, and then we'll speak to some others.
Right. Sometimes in programs like this, I've been asked, when is the right time to start preparing to sell your business? And the correct answer to that is the day you start your business, because, things that kind of get swept under the rug or, ignored or, haven't really been a problem can surface as part of this sale process. And Brian raises a good example that if, an S corporation has a lot of, we're not going to get in the weeds on this here, but S corporations have a lot of tax advantages, which is why people choose to be taxed as an S corporation as opposed to a C corporation. But if you haven't dotted all the I's and crossed all the T's in terms of applying for that, both at the federal level and the state level, which may be more than one state, as Mike mentioned, there's a whole SALT concept, state and local taxes, and that varies from state to state, obviously. And you need to have all those I's dotted and T's crossed, because if not, it could create some real adverse tax consequences to the selling shareholders if things haven't been properly documented, if returns haven't been properly prepared and filed, and so on and so forth. But it really goes beyond that to all types of tax returns, and it goes beyond taxes. It goes beyond financial, as I said. I mean, we find in due diligence, getting a little off Brian's question, but it's amazing. You find that we have a key contract. Company has a key contract, or maybe even not so key, but nevertheless important to the business, and it's never been signed by the other side. It was filed away in a drawer or whatever, but it's an unsigned agreement. And parties have been operating as if, the agreement applies, but the buyer says, well, it's not a signed agreement. Where's the signed agreement? Things like that. The three of us, three of our firms, were involved in a transaction that Brian started to touch on before, where an individual had written a substantial amount of software code that really the whole business operated off of, and was vital to the business. But this person, who was not an employee, an independent contractor, had never signed a piece of paper assigning to the selling company all right, title, and interest to that software code. And got to the closing and said, please sign this. And he said, sure, I'll sign it. And my price is X million dollars. And X million dollars was paid. X million dollars was paid.
You always want to be thinking about, I always tell my clients at the outside of a process, okay, who are the potential hostage takers in this deal? And you never, no one thinks that it could be your CTO, but in the case that Ray references, it was. And having the proper assignment in place for all this work that was so important to the enterprise value of the business ended up being a real issue. But the other hostage takers can be minority investors. If you have, if you're a business that's 100% owned, that really streamlines things. But a lot of businesses have minority partners. Sometimes they're key employees. Do you have a clear drag along right in your operating agreement with that minority partner? Does that minority partner have a right of first refusal on a deal? No buyer wants to invest 7 to 12 months in a process and maybe millions of dollars in due diligence on their third-party advisors, only to get to the finish line and have to deal with a seller needing to go to a third party that can exercise a right of first refusal and undermine the whole deal. Or if there's not a clear drag along right, what's going to be the mechanism by which you kind of force that minority partner to move forward without taking a pound of flesh? So those are very important considerations. The other is third-party consents. I mean, we always got to think about, okay, to get a deal done, who are all the third parties that you may need to go to get a consent? Right. Not just a minority partner, but a lot of contracts with key customers have requirements for a consent to assignment in an asset purchase sale, or they have requirements for a consent to a change of control in a stock sale. It would be ideal if in writing those contracts, you avoided those change of control or consent provisions, but those need to be thought about. Landlords can hold up a deal if you're not on great terms with your landlord, if you've got a dispute with your landlord over something as minor, seemingly minor as, CAM charges. They might not provide the consent that's going to be needed as a condition to closing to get to the finish line. So there's other third-party registrations, licenses, certifications, supplier consents, all of which need to be understood earlier rather than later.
Got it. So after all this, what is the final advice you can give the sellers? Like, what is one thing that they should actually, think about before actually starting the process?
Well, I would think this, we've touched on just a handful of these issues, and there's many more. And the more that, and again, they can be addressed months and preferably even years in advance of a process. So the more that you have your ducks in a row,
right,
starting with, as Mike said at the outset, you'd be surprised that companies we come across, even sizable companies in the middle market that don't have reviewed or audited statements, they only have QuickBooks statements. That's something then you need to put in place in a hurry when you're in a process. There really should be at least a few, if not several years of reviewed or audited statements, GAAP statements in place. With a quality accounting firm like Mazars. There should, all of these contracts, customer, supplier, vendor that Ray mentioned, in a recent deal, a large deal, the largest supplier contract, which was key to the deal, couldn't find a signed copy. Not one signed by the supplier. As Ray mentioned, this happens.
Yeah.
Have all your contracts, in a row. Are you in compliance with sales and use tax and all the new requirements there, et cetera, I think is the first piece of advice that I would give.
Brian, just to go back to something that both you, Brian, and Ray both said on the S corporation status, what we see is in a lot of family-owned businesses, as Ray said, they're set up for tax purposes as S corporations, and then throughout the multiple generations or through estate planning, they set up trusts. And in certain instances, there's special elections that need to be in place in order to maintain a valid S corporation. And we see time after time that those elections, they can't be produced or they weren't made, and it creates a massive holdback. And we've seen that on a very large deal recently where, you know, this held up, they didn't hold up the transaction, but it held up money going to the sellers.
Yes, if you have a trust, if you have trust, you know, you need to, and you also, and your company is an S corp, you know, that trust needs to be a qualified subchapter S shareholder, and that means you know, it's gotta, there's some very detailed rules that relate to that, and if those aren't in place, it brings the whole S corp status into question. And the bottom line is that any buyer or investor doesn't want to have a risk, however small, that back taxes for C corp tax, which are going to be that they're going to be at risk for those. So and they really don't want any risks at all that relate to the operation of the business prior to closing the deal. And those risks can relate to C corp back taxes and S corp status. They can relate to environmental liabilities, which is something we should probably spend a minute on because it always comes up. It can relate to exempt versus non-exempt employees and entitlement to overtime, which is something that we've seen come up. It can relate to immigration status of employees. It can, so that these are all things that many of us might think are nonsense risks or remote risk for a buyer, but the buyer's playbook is going to identify these as potential risks and reasons for an allocation, change in allocation of value or risk in the deal.
Ray, anything you would like to add as final, final advice you can, you know, on top of all this?
I could summarize what Brian just said in one sentence. No buyer wants to buy your problems. So
that's,
you know, and they're not buying your problems and they're leaving their problems with you. But you need, but again, to the point of preparation, you need to know what your problems are and be honest with them and the flaws that might exist. And, you know, if you want, maybe, I guess environmental may fall a little more to me. So I'll pick up on that. I mean, I don't know if, I guess at least some of our audience is in New Jersey, but it applies everywhere. But New Jersey is a state with a particular law that is triggered in many cases by the sale of a business. But environmental liabilities are very often, I can't tell you how many times we've all heard, well, I don't own the property, so I don't have a problem. If you occupy the property, and there's a problem, it's your problem. It's also your landlord's problem. It's also the prior owner's problem. But there is a concept in environmental law of joint and several liability. And I think we all know not just in New Jersey, but in the industrial parts of the United States and elsewhere that, you know, there's a history that goes back, you know, 150 years probably at this point in terms of, you know, things that have happened. And unlike many problems that one could have, a breach of contract, a failure to pay taxes, et cetera, those are ultimately quantifiable. One of the bigger problems with an environmental issue, if you have it, is it's very hard to quantify. One of the many unfortunate parts about environmental contamination is it doesn't respect property lines. It doesn't respect anything like that. So it could be your neighbor's fault, but nevertheless, if it's on your property, you've got a problem. So again, not to overstate the issue or be an alarmist about it, but it's something that, you know, everyone who's a buyer, everybody who's a seller needs to be sensitive to, because it's very much an unquantifiable, you know, if it's beyond a minor type of issue, it's very much unquantifiable, and that creates an additional level of uncertainty. Not only does the buyer not want to buy your problems, a buyer like any buyer of anything, whether it's
Yeah.
a new car, new house, whatever, doesn't want uncertainty. They want to know that it is what I think I'm getting, which is what this whole due diligence process is really a buyer wanting to know as much, they very often spending millions of dollars to acquire the company. They want to know to the greatest extent possible and to the greatest level of detail possible that they know what it is they're buying, no surprises.
Got
And but environmental is, certainly, we're not going to have time to go through all the various elements, but environmental is certainly something that one needs to be sensitive to.
Yeah.
Or in planning and setting an effective plan for an M&A transaction in the future, like Ray said, you start planning from the day you start your businesses, from day one. So we get very involved with our clients from setting up and dressing up for the occasion, maintaining proper P&Ls with proper profit and cost centers, easy to understand fixed and variable costs. I think in various segments of the business is really important. Diving into inventory costing is a very important area to be addressed. It includes overhead allocations and a lot of subjective components. And in my experience, owners have a much better handle on the customers and revenues than they do on the cost, because the costs are blended and they're spread amongst many different customers or cost centers and categories. So we see standard costing for inventory often doesn't include labor and overhead, or the bill of materials are not revisited timely. And many different ways to handle this through business analytics or intelligence, diving into profitability analysis, SKU rationalization, and evaluating business cases. These are all common things that come up, like not properly capturing landed cost. That could really increase the purchase price because your EBITDA will go up because your inventory hires should be great. Your inventory should be greater.
Yeah.
Cleaning up credit balances in your accounts receivable or checks, unclear checks in your bank rec. I've seen that come up as unclaimed property issues. You don't want to deal with that when it comes to the transaction. You want to clean that up well in advance. And these are common areas that need to be addressed up front, well in advance of preparing to sell your business.
Yeah.
Let me just add, Corinne, that we've been working together, increasingly successful obtaining something known as reps and warranties insurance, even for relatively smaller middle market deals, whereas reps and warranties insurance used to only be obtainable for much larger deals than what you see in the middle market. And reps and warranties insurance is just a terrific product for the seller. And we generally, in a competitive process, will require that buyers obtain that in order to be to get to that exclusivity that we talked about. And in a deal where we're able to take all these issues off the table as regards exempt, non-exempt employees, environmental risk, sales and use tax, S corp status, it means that if you have a $25, $50, or $100 million purchase price for a business, the seller gets that entire purchase price at closing, rather than having what used to be traditionally like a 10 or 15% escrow or holdback for 12 or 18 months. Though, if these issues are identified in due diligence and they've not been addressed prior to a sale process, they result in carve-outs to the reps and warranties insurance. The insurer doesn't want to insure known risks, so they become also carve-outs to the reps and warranties and the caps and the thresholds that Ray negotiates in these purchase agreements. And it really increases the risk for the seller in the deal, and reduces, and to the extent that there's holdbacks for those items, it reduces the amount they get at closing. So I know everyone thinks about maximizing valuation, which of course is of paramount importance, but next in importance is minimizing risk, and really making sure that the indemnification provisions are as favorable as possible for the seller.
Got it.
I think we may have jumped over a little bit, and I just want to go back to what Brian was saying, and we're not going to have time to really address the purchase agreement, but in any great detail. But if you've been involved in a deal like this, the letter of intent might be 6 pages, and the contract purchase agreement may be 60 pages. How does the same deal, require 10 times more paper? And it's because a large part of that agreement will include what are called representations and warranties, where all the things that were said in due diligence, provided in due diligence, shown to the buyer in due diligence. And this is now where the seller has to stand behind it and go on for 20 or 30 pages, literally backed up by hundreds of pages of disclosure schedules. Now you're legally committing to everything that you've said in due diligence. And Brian mentioned identification. Identification is simply, not simple, but is basically the seller standing behind everything it has said. If it turns out to be untrue, incomplete, inaccurate, anything of that nature. And the rep and warranty insurance that Brian mentioned is a way to put off, just as any type of insurance, to put off that risk on an insurance company, which will also do substantial due diligence. One of the advantages of insurance is you take the risk away from the seller to a large extent.
Right.
One of the disadvantages, and it's a worthwhile disadvantage, is that you've got 2 parties doing due diligence on you, not just the buyer, but the insurance
Also
company.
insurance carrier, yeah.
Because they're insuring, as Brian said, known and unknown risks. They want to make sure that everything is known. They're not going to insure the knowns. But that's become a very, very important and a very beneficial part of the type of transaction that we've been talking about here. And but I think it's important to be prepared, because again, I can't tell you how many times, when we're doing those disclosure schedules, when we're doing the representations and warranties, that the seller will say, well, we already answered that in due diligence. Well, this is going back to square one when you get to the reps and warranties, and it's the same information, and they're going to check again. That's, in a way, that's due diligence as well. The buyer and the buyer's attorneys and the buyer's accountants and advisors are going to be, again, asking those same questions. And what about what you said in that conference call we had 6 weeks ago? You're going to get questions like that, but that's why having your story straight, complete, thorough, and accurate is vital, but you are going to have to stand behind it at the end.
Got it.
And maybe you can get insurance. And again, that's become more and more common, and it is a very positive feature in these transactions.
Thanks, Ray. We do have a couple of questions now. We actually received some questions beforehand, and one of the questions is, maybe Brian or Mike can answer this, or even Ray. Since the value of any business is based on its potential to generate cash flow on the investment, what is the best way to get entrepreneurs to focus on their cash flow instead of the top line revenue growth?
Yeah, it's a great question. Cash flow is very important, fundamental to the valuation. And as Mike commented earlier, the approximation that most strategic and financial buyers use for cash flow is EBITDA, right? Earnings before interest, taxes, depreciation, and amortization as the basis for evaluating. You want to maximize your EBITDA as a proxy for your cash flow. But the other key determinant of value is the multiple that's assigned to the EBITDA. And that is very much a function of growth, and higher growth businesses and software services, pharma, et cetera, command higher valuations and multiples. And more mature industrial companies, I'm generalizing here, but they maybe warrant lower multiples. The multiple is a function of growth. So both are very important. And you really got to find that right equation for your business, and not just be thinking of one at the expense of the other.
Got it. Let me see if I think we may have time for one more question. This is a question that actually just came in. How do the employees that are not principal but have a very high amount of their life invested in the business get compensated or taken care of?
Well, that's all over the lot, but most, or at least many, I should say, sellers of business do want to reward the key
Yep.
players. It goes beyond even rewarding them, with some sort of bonus at the time of a closing, which can take many forms, but also ensuring to the greatest extent possible that those people have jobs after the fact. I think the vast majority of companies we've all represented, the owners realize that the employees got them where they are and they're getting them, the payday that they're getting at the time that they sell. And I would say, I think it's safe to say, I think Brian and Mike would agree that they do want to take care of those people, not only in terms of bonuses for key players, but also in terms of, jobs post-closing.
Got
Just
it.
to jump in there really quick, I know we're running out of time. There's a really big planning opportunity about who pays those bonuses at closing, whether it comes from the buyer or the seller. And what happens many times, if it's not clear or it just happens and it comes out of the closing, there's an opportunity for the sellers to take a very large tax deduction. So you want to make sure that you clearly outline that in the purchase agreement, because the impact to paying and remunerating and keeping and retaining those employees, you could get a really large tax benefit as an ordinary deduction off the sale price. So that retains a lot of proceeds for the sellers.
Got it. Well, we're running out of time. Thank you, everyone, for being part of this panel. We hope that you enjoyed today's webcast. I know there are quite a few questions that actually are coming in, so we're going to answer them after the webcast. So again, we hope you enjoyed today's webcast. Please tell us what you think about what you thought by completing the webcast feedback form, which you will see shortly as a link in the chat box. And we also hope that you find the M&A playbook helpful, and our experts will be reaching out to you shortly with a complimentary M&A consultation offer. So again, thank you, everyone, and enjoy your day. Stay safe and healthy. Thank you for joining.
Thank you.
Thank you, everyone.
Thank you. Thank you, Martin.
you.
Thank you. Thank you, Mike. Thank you.